Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
This is Mike Leeson with Money Metals Exchange, and it is my privilege now to be joined by John Rubino of DollarCollapse.com and Bearing Asset Management. John is a former Wall Street analyst, a writer for CFA Magazine, and a featured columnist with TheStreet.com. He's also authored several books, including The Collapse of the Dollar and How to Profit from It. John, it's good to have you back. How are you?
Great to be back, Mike. Good to talk to you again.
Well, we'll get right into it here since time is limited. So to start out, we've seen some disappointing earnings reports coming out lately. Why do you think U.S. companies are showing sign of weakness here?
Well, that's really the big story right now. We've seen some brutally negative earnings reports on the part of some very big companies, and part of it is that the dollar is really strong, and that creates a headwind for a multinational company that's making stuff in the U.S., pricing it in dollars, and trying to sell it to the rest of the world. Because when the dollar goes up, that means whatever they're trying to sell is more expensive than it was when the dollar was weak. And so that naturally impacts corporate sales and therefore earnings. But there's a lot of other stuff going on now too. You know, the energy market has just tanked in the last year. So anybody whose earnings are related to energy prices is affected by huge swings in the oil market, for instance. But also coal companies are tanking, and the commodities bust is now global. So that affects anybody who is involved in mining or selling equipment to the miners. You know, Caterpillar, which is the biggest earth-moving equipment company in the world, has just gotten crushed lately. They've had multiple quarterly negative sales reports come out over the last couple of years. And it just goes on and on. You know, the big banks are not functioning well in this low interest rate environment. You know, they like low interest rates, but they don't like incredibly low interest rates because it makes it hard for them to find people to lend to, and to lend at a wide enough spread that it is profitable for them. And then there's the volatility in the financial markets. You've got stocks and bonds going up and down, and without really rhyme or reason, because a lot of it is just based on whatever the latest talking head from the Fed or the government said on CNBC. You know, there's no fundamentals at work there. And that's making it hard for the big banks' trading departments to make any money, because they can't manipulate these markets the way they can manipulate fairly stable markets, where they'll have one part of their trading desk place a bet, and the other part of the trading desk push the market towards that bet. You know, they can get away with stuff like that when there's no Fed talking head out there saying some controversial thing and sending the markets rolling in one direction or the other. So anyhow, there's widespread weakness in corporate sales and earnings right now, and that's very scary from the point of view of the financial markets, because stocks and bonds are priced for perfection. In other words, you need a really good environment to justify the level of the S&P 500 stock market index, for instance. And by definition, a favorable environment for stocks is one in which corporate profits are going up, because that raises the value of these companies. But let their earnings start to go down, and that calls into question current stock price valuations. And that's happening out there right now, where you see companies blowing up right and left, and it's affecting the ability of even the best investors out there to make money in this kind of a market. I just published something this morning with the title, "Genius is Failing, Hedge Fund Giants Burned by Changing Markets." It lists some stories about how Bill Ackman, a billionaire hedge fund manager, has one company, a big pharmaceutical company, of which he owns a huge stake, blowing up on him now. He's losing billions of dollars on that. David Einhorn, one of the great investors in the hedge fund world right now, who's had a string of up years, only one down year in something like 15 years, is getting crushed this year. He's down like 17%. And that's because he placed a series of bad bets. He's getting crushed. Warren Buffett owns a huge number of big brand name multinationals like Coca-Cola and IBM and Wells Fargo. And a lot of them are getting beaten up now too. So he lost a few $1 billion in the past week. So even the giants in the world of investing right now are having trouble figuring out what to do. And that makes complete sense. That's exactly what you'd expect in a world that's undergoing a phase change. This is no longer business as usual because so many big trends are getting ready to roll over or hitting a wall. The debt binge has to end at some point, for instance. We can't continue to grow via increasing credit year after year after year. Fiat currencies are going to stop working, and they already are working less well than they used to. You're seeing so much currency turmoil out there that makes it harder and harder to figure out what's going to happen in the year ahead and therefore how to invest accordingly. And so the financial world is going to be thrown into turmoil by the combination of these factors. So it's going to be a fascinating few years to watch this process play out and to see who adapts and who doesn't.
Given that a strong U.S. dollar is at least somewhat of a factor here with making it tough for them to be competitive in the global marketplace, how do you see that influencing upcoming Fed policy?
Well, the Fed really wants to raise interest rates because that's their ammunition. High interest rates allow them to cut interest rates during the next downturn. And they're facing the prospect now of heading into the next downturn because the economy has been growing for 5 or 6 or 7 years, depending on how you calculate it. And that's a long recovery. Usually you get a recession after that amount of time. And they haven't been able to raise interest rates yet, so they really want to. And they keep threatening to do it. But the global economy is failing. The quantitative easing around the world has really not worked the way the textbooks say it should. You cut interest rates to zero, you run massive government deficits, and you finance those deficits with newly created currency. You should create a rip-roaring boom that leads to lots of people being hired, lots of people getting raises, and then you have wage inflation, and then you have to raise interest rates to cool things off. Well, that's not happening. And a lot of the internals in the U.S. economy have turned negative. Manufacturing across the board is falling, and consumer spending is not growing the way you would expect with these top-line job numbers coming out. If unemployment is 5%, people should be spending a ton of money, and they're really not. And all that's really pumping up the economy right now is car sales, student loans, and to an extent housing. And those are very cyclical, undependable trends. You can't expect people to keep borrowing money to buy new cars when they lock themselves in for 7 years on a car mortgage. If enough people do that, there's no new car demand out there in the future because everybody's already locked into a long-term car loan. Same thing with houses. We build a certain number, and that's all we need for a while. And of course, student loans are bankrupting a whole generation of college graduates. So we've got all these things that the Fed can look at, just like you and I can, and they can see that they're really problematic. And if they raise interest rates, they run the risk of blowing up these bombs that are just sitting there waiting to blow up. So much more likely in the year ahead is that the Fed's going to reverse course and say, all right, I guess we can't raise interest rates after all. We're going to cut rates, and we're going to institute a new quantitative easing program. Maybe we'll call it something different, but it'll involve bigger government deficits, more money creation, lower interest rates, yada, yada. And this morning, in a sign of what's coming, the head of the European Central Bank announced exactly that. He intimated that more QE was coming in Europe. And the reason for that is that Europe's not growing. They did a lot of quantitative easing. They've got negative interest rates in many European countries, and it didn't work. And same thing in Japan, where for decades now they've been running massive deficits, financing it with borrowed money, running up huge amounts of debt, and they're still flat on their backs economically. China, of course, had this huge debt binge since 2008, 2009, where they quintupled their national debt, and that didn't work. They built a lot of stuff that turns out not to have been needed and isn't generating the kind of cash flow necessary to finance the related loans. And so China's seeing a pending credit crisis. So you add all that up, and it's fairly certain that in 2016 and 2017, the dominant policy among the major governments of the world will be easing, quantitative easing, massive deficits, lower interest rates, and other various kinds of programs designed to get a weak economy moving. The problem is, of course, that we've already borrowed so much money that it's not clear that new debt is going to have any kind of a positive effect, and might indeed have extremely negative effects. And new money creation won't necessarily help in any way, because we've already created, massive amounts of dollars and euros and yen and yuan, thrown them out into the market, and they have not produced the boom that you would normally expect from the original numbers. So in the next couple of years, there's a very good chance that the world figures out that the governments and central banks that have been managing their currencies and their economies are out of options, and that they've tried everything that they know how to do. They've thrown every weapon that they have against the debt liquidation that's been going on since the housing bubble burst in 2007, and it's not working. And so then we get a phase change in market psychology, in which people lose faith in the adult supervision that the markets have been thriving under for the past few years, and all head for the exits in at least one or two major asset categories. Maybe they lose faith in bonds because they don't think the value of the major fiat currencies will be maintained in the future. Maybe they lose faith in stocks because they don't think corporations are going to be able to make good money and increase their profits going forward in this kind of an environment. You don't know which areas of the system will blow up first, but it's a fairly safe bet that we're going to see turmoil in stocks, bonds, commodities, and certainly in the political system out there in some combination. And of course that feeds back into your business, which is selling precious metals. In this kind of turmoil, historically, people have chosen to hide out in precious metals. Capital flows into the kinds of money that governments can't just create in infinite quantities by typing in a number and hitting send. So the things that are in limited quantity, like gold and silver, are going to look better and better in a world where interest rates are negative, so bank accounts don't pay you anything, and where stocks and bonds are incredibly volatile and untrustworthy. And then you'll have gold and silver just sitting there in terms of supply, growing by 1 or 2% a year, with their 3,000-year history of maintaining their value. And people are going to come to the conclusion that this is a pretty good deal in this kind of an environment. So you see a lot of capital flowing into precious metals, I think. And of course, I thought that was going to happen for the 2 or 3 years previous to this too, and it hasn't really happened on any scale yet. But we're seeing signs that that both small investors, the buyers of gold and silver coins, are starting to catch on and are buying vastly more such coins now than they were 2 or 3 years ago, and that some of the big governments like China and India are aggressively buying gold and silver. So let those two trends continue, and then the rest of the financial markets start to edge in and start moving 1 or 2 or 3% of available cash into precious metals, and you'll see a rockin' bull market, something reminiscent of 2010, 2011 in 2016, 2017. So I think we have a good chance of that occurring, and the main question is timing. Does it happen sooner or later? Do we have to wait till 2018, or will we start to make some serious money in precious metals next year? There's no way to know that, but I think the end result of the current set of policies is almost certainly great for precious metals.
I want to ask you about silver specifically because it's both a money metal but also an industrial metal, meaning it's both pushed and pulled from different directions. Since it has so many industrial uses, it often trades like an industrial commodity like copper, for instance, but it can also get a boost based on monetary demand. So how do you see silver performing in the face of a worldwide economic slowdown? Because if we see a recession, you have to think the central banker's response will be to print money and monetize debt, as you just mentioned a moment ago. So what are your thoughts on silver in the near to medium term, given this push-pull situation with this unique metal?
Well, yeah, there are a lot of moving parts in the silver story. And on the one hand, like you said, it's a monetary metal, and it tends to move based on the same factors that affect gold. So if gold goes up, silver will go up also, and probably by a bigger percentage because silver's so much smaller, thinner market. And the fact that it's an industrial metal is actually good for the monetary story because the silver that's used in most industrial applications is not recycled. It just disappears once it's used. So we're taking silver off the market at a time when we don't take gold off the market. You know, gold is money, and that's all it is. And so all the gold almost that's been mined since the beginning of human history is still around, sitting in vaults or jewelry boxes or wherever, places where it's saved. So there's a lot more gold out there than there is silver relative to their prices. So silver, if it's caught in a monetary demand updraft, should spike. You know, it should just take off relative to gold. And at the same time that you got this monetary demand that is increasing now, you know, people are buying a lot more silver coins than they used to the extent that the U.S. government has to ration the silver eagles that it produces because it can't produce enough to meet ongoing demand. At that same time, you've got rising industrial demand from interesting sectors that are fairly new, like solar power. You know, every new solar panel at the moment contains a little bit of silver. So as solar booms, which it is, solar is just taking over the energy market, which is a fascinating story in its own right. But it pulls silver along. Right now, the amount of silver that's being used in the solar market is dramatically greater than the amount of 3 years ago. And 5 years from now, assuming that solar remains part of the mix for the average solar panel, it'll be vastly bigger than now. So to the extent that you have this rising demand from industrial applications and rising demand from monetary interest, that's a really good mix for silver. It looks like it could see kind of the perfect storm in terms of higher prices out there in one of these years when both hit at the same time. You know, when solar becomes really high profile and people start figuring out that that's actually a new use for silver and it's growing like crazy, and everybody figures out that the central banks of the world have basically lost it. They no longer have the ability to manage the monetary system of the world, and they're just going to inflate away the major fiat currencies because they have no other way of keeping us out of a depression. Let those two things happen together, and silver could really rock. I think you could easily see a return to $50 an ounce, and maybe quite a bit more, because thin, highly volatile markets tend to overshoot in both directions when the trend is right for a move up or down. And I think the future move for silver is definitely up. And it's just a question at that point of how excited people get. You know, if everybody decides that silver is the place to be, and there's hardly any silver available out there, then you could get some real gaps up in terms of price. And the people who own it now and are just stacking, you know, just putting it away, not really thinking about how much it's moving this week or this month or this year, they're going to have a really fun time watching their net worth soar. And again, it's timing, though. You know, I wouldn't say mortgage the house and buy a bunch of silver this year because next year all of this is going to happen. That's a completely unpredictable thing. But I would say continue to buy a little at a time and let your total build up, and don't really stress out over what it's doing in the short run, because somewhere out there is a really good year in which, if you want to, you'll be able to sell part of your stack for a huge profit. And then the question becomes, what do you convert it into? Do you want to hold these fiat currencies, or do you want to buy real stuff? You know, that's a nice problem to have, but it will be a problem eventually. You know, you'll have to choose wisely when you start converting your silver into other things. But again, you know, that's a 2017, 2018 issue for most people, and one where we can come back and talk more about it then.
As we begin to close here, since gold and silver prices have risen 5 to 10% in the last few weeks, we've actually seen a bit of a decline in retail demand from the very high levels over the summer. Why do you think that is? Are people just not buying into the rally because we haven't seen a lot of follow-through over the last few years when we did get an advance? What are your thoughts there?
I think day-to-day, week-to-week, month-to-month trading is completely unpredictable and unexplainable, except in retrospect. The markets just do what they do in the short run. And, it's true, gold and silver seem to be firming up a bit, and which feels good. But that doesn't mean they can't just fall off the table next week or next month and go back down and test their previous lows. So we can't read very much into single-digit percentage moves in the short run. But what we should be focusing on is the underlying fundamentals, which are very, very positive, and which eventually will work out. So I would say that if you're doing dollar cost averaging, if you're just stacking, week after week or month after month, that lower prices are actually a positive thing in the short run because it lets you buy more. And if they take off and go up from here, that's great. If they meander around from here, that's okay. And if they go down a little bit, that's okay too. As long as you have your eyes on the prize, which is $50 silver or $75 silver, then whether it goes from 15 to 22 this year or 15 to 13 this year shouldn't really matter all that much, because out there somewhere is that great year when everything goes your way. And that's what we should be focusing on.
Metals markets certainly are teaching a lot of investors patience, but I think you're right. Eventually we are going to see that big move. It's just a matter of when, not if. Well, outstanding stuff as always, John. We appreciate your time and look forward to catching up with you as this all unfolds. It figures to be very interesting, both later this year and into next year. I know you're a busy guy. We really appreciate your time and your great insights as always.
Great. Thanks, Mike.
Well, that will do it for this week. Thanks again to John Rubino of dollarcollapse.com. John and his staff put out some first-rate stuff. You'll also find information there about a number of books that John has authored, so be sure to check that out. Again, it's dollarcollapse.com. And don't forget to check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.